Hello, my name is Danica Mock, and I am a member of a group of student equity research analysts at Tulane University. Our group members are Eric Andrews, Sam Olmsted, and James Post, and we prepared an investment research report on the company Hibbett Sporting Goods. Today we will talk to you about Hibbett's stores, Hibbett's strategy, and our analysis of its stock. Hibbett was founded as Dixie Supply Company in 1945, selling athletic, marine, and small aircraft equipment. By the 1990s, main retail establishments were the 5,000 square foot stores that sold only athletic equipment. After seeing potential for growth, the investment firm Saunders, Carp and Company bought control of Hibbett in 1996, looking to take it public. In October 1996, Hibbett went public on the NASDAQ for $16 per share. Based on the price-to-earnings and price-to-book value valuation methods, we give Hibbett Sports a market perform rating and project a 12-month target price of $56. When we constructed our forecasting model, we examined how Hibbett's aggressive expansion, its product mix, and the overall economy will affect its growth. Hibbett plans to grow organically at 5% a year so as not to overextend itself in different regions. Hibbett has a strong financial position in the sporting goods industry and uses company internal equity to finance all of its new store growth. Management recognizes the considerable population growth in the South compared to the North and exploits optimal locations in booming regions such as Texas. Because of Hibbett's equity-heavy capital structure and extra cash, management has provided guidance for share buybacks at 4% of shares outstanding per fiscal year. Hibbett projects both an increase in the number of stores nationwide as well as an increase in sales per store by tailoring its product mix to specific locations and consumer markets. The buyback program is a way for Hibbett to boost share price and give cash back to investors. Hibbett insulates itself against large competitors and differentiates itself from small independent retailers by using a unique and flexible model for product mix. Independent competitors have difficulty competing with Hibbett's variety of products, the assortment of which is usually only offered at large sporting goods stores. Hibbett carries an extensive product selection of name-brand items accompanied by a mix of regionally focused apparel. Hibbett benefits from this relationships with vendors such as Nike, Mizuno, and Under Armour. These relationships give it a major advantage competing with independent retailers in small markets. Hibbett also competes with local retailers with a variety of regionally focused apparel such as merchandise for local high school, college, and professional sports teams. Hibbett's products can be divided into three major categories: athletic footwear, athletic apparel, and sporting equipment. In addition to its core selection of products, brand name apparel, and higher-end products, each store has a specialized selection of regionally focused apparel to attract a wider range of customers throughout its varying geographic regions. In order to maintain high margins, Hibbett only offers full-price products instead of a mix of discount and premium products like many of its competitors. The primary Hibbett retail location is its standard 5,000 square foot store. However, Hibbett has other retail stores as well. To compete directly with Foot Locker, Hibbett opened Sports Editions, which are smaller stores that primarily sell athletic footwear. In an effort to compete with larger big-box sports retailers, Hibbett opened Sports & Co. Sports & Co. is Hibbett's only retail sporting goods superstore and is located in Huntsville, Alabama. Finally, Hibbett owns a subsidiary store that provides customized athletic equipment and clothing to schools and organizations called Hibbett Team Sales, Inc. Despite multiple other store locations, Hibbett has expanded throughout the United States, primarily with its 5,000 square foot format stores. Hibbett typically places these stores in strip malls and close to Walmarts to attract foot traffic in small towns.
Hibbett has a unique strategy compared to its competitors. Hibbett positions its stores in smaller markets with populations ranging from 25,000 to 75,000 people. By targeting smaller markets, Hibbett is able to grow nationally but maintain the regional feel. Additionally, the small market approach isolates Hibbett from big national competitors, allowing them to only compete with smaller mom-and-pop stores. Hibbett refers to its strategy as clustered expansion growth model. In this strategy, all new Hibbett establishments are opened within a 2-hour driving distance of an existing Hibbett store. By using this model, Hibbett is able to solidify its brand in an area while taking advantage of closer distribution points. The growth in Hibbett store locations has been astronomical since its initial public offering. When Hibbett went public, it operated 67 stores. As of January 28, 2012, Hibbett operates 832 sporting goods stores in 26 states. 812 are traditional Hibbett sports stores, 19 are sports edition stores, and it operates one sports and company superstore. The first thing that we noticed when we walked into the Hibbett headquarters was how friendly and casual the company culture was. We met with Hibbett's new Chief Financial Officer as of July 7, 2012, Scott Bowman, and its Chief Executive Officer, Jeffrey Rosenthal, for 2 to 3 hours. As we walked by the boardroom, both Mr. Bowman and Mr. Rosenthal were waving at employees as they walked by, and it was clear that even top management knew many employees in the company. While talking with management, we learned about Hibbett's growth strategy in the Sunbelt states and the strengths that come with having so many sporting goods stores located in regions where the weather is conducive to sports activities all year round. We also discussed the risks of Hibbett's plan to move to a new distribution center and corporate headquarters in 2012 to accommodate its future expansion. Management assured us that the company culture would not change and the productivity of Hibbett would increase with its new transition. Hibbett's stock price has grown consistently and steadily since the 2009 stock market bottom. Its price growth accurately reflects its aggressive expansion and its successful revenue growth. Despite the huge run, we believe that as of November 6, 2012, Hibbett stock is fairly priced.
Hibbett is a part of the sporting goods industry, a $417 billion section of the specialty retail industry. The sporting goods industry is highly fragmented with no clear industry leaders that hold huge market shares. Customers have many options for buying substitute sporting goods products. Many substitute stores, such as Walmart, offer discounted and lower quality equipment. Additionally, products sold online can compete with Hibbett stores as well. Hibbett offers only fully priced, brand name products, which could make competing with discount stores difficult. However, to insulate itself against competition, Hibbett places stores in lightly populated areas that give the surrounding customers fewer options and decrease the availability of substitutes in the highly competitive industry. The main competitors for Hibbett are Dick's Sporting Goods, Big 5, the Sports Authority, Foot Locker, and Academy Sports and Outdoors. Hibbett's competitors offer similar product mixes, but successfully compete with one another because of different regional focuses as well as certain specialized product focuses. Large sporting good retailers have made it difficult for new companies to enter and compete in the sporting goods market. Established incumbents in the industry with widespread locations make penetration difficult for emerging companies. Hibbett's expansion model enables it to stay away from most competitors, and only 25% of its stores compete with other sporting goods stores. Hibbett is an intermediary company between its customers, the public, and its suppliers. Hibbett's three main suppliers are Nike, Mizuno, and Under Armour. Hibbett relies heavily on the relationship pricing it maintains with its suppliers, as well as the innovation and development of popular new products. While its customers have a variety of options for purchasing cheaper sporting goods products, Hibbett stores provide customers face-to-face interactions with knowledgeable employees, and customers are willing to pay for this experience. Because the retail sporting goods industry is highly fragmented, we found it difficult to select easily comparable peers. From our options, we chose other retail sporting goods industry leaders like Dick's Sporting Goods, Big 5, Foot Locker, Sports Authority, and Academy Sports and Outdoors. Dick's Sporting Goods operates 480 stores in 43 states. It has a wider geographic reach than Hibbett, but fewer store locations. Typical Dick's Sporting Goods stores are between 35,000 and 45,000 square feet, making them more similar to Hibbett superstores than regular format stores. Big 5 operates 406 stores in 12 states, all located in the western United States. It provides similar product lines as Hibbett, such as shoes, apparel, equipment, and accessories. However, it is in a different geographical location, therefore, it doesn't directly compete with Hibbett. Its stores are typically 11,000 square feet, which is still double the size of normal Hibbett stores. Foot Locker operates 3,369 stores across the globe. It has strong brand strength and has led to many popular specialty stores like Lady Foot Locker, Kids Foot Locker, and Foot Action. Sports Authority operates 460 stores in 45 states. It sells multiple brand name products as well as its own private labels. Sports Authority recently launched a new store brand called SA Elite. SA Elite is a smaller store that sells high-end sporting goods, very similar to Hibbett. Academy Sports and Outdoors operates 138 stores in 12 states. Unlike Hibbett, Academy is a discount sporting goods retailer. Its regional location is similar to Hibbett, but its product mix is marketing to a different demographic. Hibbett's market cap of $1.55 billion falls in the lower end of its peers, with the peer average at just over $4 billion. Hibbett is trading at 21.26 times earnings, on par with the peer average of 21.87. Hibbett's price to book value is more than double the peer average at 6.25 compared to the average of 2.6. The enterprise value to EBITDA is 11.05, marginally higher than the peer average of 8.39. Hibbett differs greatly from its peers in that it has almost no leverage, with the debt-to-equity ratio of 0.09, whereas the peer average is 14.29. Its return on equity is 32.54%, which is almost 3 times higher than the peer average of 13.51%. Hibbett's stock price as of November 6, 2012 was $53.95. We assigned Hibbett a one-year target price of $56. To arrive at this target price, we examined 4 valuations using different methods. We chose to value Hibbett using the relative multiple method, but used Hibbett's historical financial data from the past fiscal years instead of using the company's peers. We felt that the peer group was not similar enough to provide us with an appropriate valuation of Hibbett. The 2 methods we believe most adequately represented Hibbett's value were the price to earnings and the price to book value, because it captures Hibbett's strategy of constant growth without debt. These 2 values were closest to Hibbett's current stock price and we believed were an accurate representation of the value of the firm. Using price to earnings, we valued Hibbett at $58.73 per share. Using price to book value, we valued the company at $54.08 per share. We chose to take into consideration both of those methods to provide us with a 12-month target price of $56 for Hibbett. We also valued Hibbett using the price to cash flow per share and discounted cash flows. However, we believe these methods were not as accurate as the price to earnings and book value evaluations, and therefore did not include them in our target estimation. We think that Hibbett's growth strategy will be effective, and we like management's approach to expansion, but we would wait for a better entry point to establish a position. Earnings have grown steadily, and we believe that the past success will continue. The stock has rallied around 35% in the past 12 months, and now trades at a high 22 times earnings. Even with this high multiple, we feel that the stock is a good long-term hold. On behalf of our group and the Burkenroad Reports program, I'd like to thank you for watching our video.
Nice.